Hey, today we're going to talk about gross profit margin, net profit margin, return on assets, and return on equity. Our final group of ratios looks at profitability. We will evaluate gross margin first. This is equal to net income divided by net sales, which means it's equal to revenue minus COGS divided by revenue. This ratio indicates the profitability before other expenses have been removed. To understand its significance, however, we need to compare our ratio to our competitors and to our industry standard. The second profitability ratio is net profit margin. This is net income minus operating expenses and other expenses such as interest and taxes, all divided by revenue. Since this includes all expenses, it's actually a better indicator of the overall company profitability. Another profitability ratio is return on equity. This is net income divided by shareholder equity. This ratio provides a look at how effectively the company is using its investors' money to generate income. And the last ratio is return on assets, which is equal to net income divided by the average total assets. This is a measure of how effectively a company is using its assets to generate income. To calculate these ratios, we'll need an income statement and a balance sheet. We created an income statement in one of our prior lessons. From the income statement, we'll need total revenues, the total cost of goods sold, and the operating expenses. We use the balance sheet to give us our total assets and our total equity. Turning our attention once again to XYZ, their gross profit margin is 0.67, which was found by subtracting the $250 COGS from the $750 of revenue and then dividing it by the $750 revenue. This shows that XYZ is retaining 67% of the revenue after accounting for COGS. Without knowing their industry standard, this appears to be pretty good. The higher the ratio, the better.
XYZ's net profit margin is skewed because our ledger didn't show a lot of operating expenses, such as utilities and interest.
So taking our $750 revenue, subtracting $250 COGS, $200 in operating expenses, and then dividing it by the $750, we get a ratio for 0.4 for our net profit margin. This is about half of our gross profit margin, which means that our profit is very sensitive to our other operating expenses.
Return on equity, which is net revenue divided by shareholder equity, is 0.02. Not good. This low ratio value indicates XYZ is not using its shareholder money very well to generate income.
And that brings us to the last ratio, return on assets. Return on assets is net income divided by average total assets. XYZ's net income is $500, and its total assets, shown on the balance sheet, are $42,500. This produces a ratio of 0.01. This low of return on assets indicates that XYZ is just not generating enough income from the overall assets that it has.
Let's share with the students some follow-up lessons we have that can help them continue with their transition to management.
Sure. Some follow-up lessons would be creating an income statement, creating a balance sheet, effectiveness ratios, and liquidity ratios. If you enjoyed this lesson, like us on Facebook, subscribe to our YouTube channel, and visit our website.